Block, formerly known as Square, has caught the attention of investors for a number of reasons. Number one, it's seen incredible revenue growth as it attempts to disrupt the lucrative payments industry. Number two, its CEO is Jack Dorsey, the co-founder of Twitter. And number three, the stock has been exceptionally volatile. It's crashed 80% since its all-time high, but it's still up more than 350% since its IPO back in 2015. That share price gives Block a market cap of $36 billion, with $6.5 billion of cash and investments and $4.1 billion of long-term debt. The enterprise value is roughly $34 billion. Revenue at Block had been growing at a rapid rate of over 50% a year, but last year saw an unexpected drop of 1%, coming in at $18.6 billion for the last 12 months. And the company is not profitable. EBITDA was negative $40 million and net income was minus $365 million. A lot of that is due to heavy stock-based compensation, which comes in at $1.1 billion. Revenue at Block is split into four buckets. Bitcoin revenue linked to Block's Cash App totaled $7.5 billion and makes up 40% of the total. Transaction-based revenue was $5.9 billion, which is 32% of the total. Subscription and services made $5 billion, 27% of the total, and hardware was $0.2 billion, 1% of the total. Although revenue is impressive, it's important to consider profitability. Subscriptions is the most profitable segment with 80% gross margins, and transaction-based revenues has a 37% gross margin. But Bitcoin revenue, despite being the largest revenue driver, has a gross margin of 0.02%, meaning it barely contributes any profits at all. And the final segment, hardware, has a negative gross margin. But let's assume that Block can return to growth, and let's assume its transaction and subscription revenues on their own compound at 10% a year for the next 10 years. If it can operate at a similar net margin as PayPal at 15%, that would see the company produce $4.2 billion of net income in 10 years' time. A 25 times multiple on that figure gets us to a market cap of $105 billion, which works out to an investment return of 11.3%. Crucially, that's without any contribution from Block's Cash App. If you were to include future profits from Cash App, then the returns could be much higher. However, before buying shares in Block, there are a number of red flags to consider. Hindenburg Research released a long and scathing report accusing Block of inflating the user numbers of its Cash App. The short seller reported that Cash App has barely any compliance and it's become the payment system of choice for criminals. Block CEO Jack Dorsey is also an interesting character. Last year, he pushed through a $240 million acquisition of Kanye West's company Tidal, despite the majority of shareholders being against the deal. This ended up in a lawsuit which Dorsey won. Overall, Block has some promising technology, but when you put all the red flags together, the stock-based compensation, the drop in revenue, the short seller report, and the actions of the CEO, it's best to steer clear of this stock. For these reasons, I give the stock a negative rating, but these are my personal opinions, not financial advice, and I hold no position in Block.